These companies remain attractively valued and ripe for the picking. NVIDIA, believe it or not, the chipmaker's stock is trading at its lowest valuation in 8 months. Chipotle Mexican Grill. The restaurant chain's post-earnings sell-off has been overdone. PayPal. Currently near a 52-week low, PayPal is now trading at just 17 times future earnings. Let's dive in. Here are the 3 very oversold growth stocks to buy right now. Welcome to Timely Investment Research. While markets remain up on the year, not every stock is shared in the gains. There are many securities that have fallen over the last 8 months and fallen hard. Plus, some stocks continue to have attractive valuations despite posting big increases this year. Few, if any, stocks have tested new highs following the bear market of 2022. This is all good news for investors as it means that people can buy stocks that are either attractively valued or undervalued. Many stocks have only gotten more attractively valued in recent weeks due to the market downturn experienced in August. Taking positions in solid stocks now when they are down or still fairly valued should lead to big gains once the market catches up and the share prices inevitably rise. While it may take some time for certain securities to turn around, there are bargains to be found for investors who can exercise some patience. Here are 3 very oversold growth stocks to buy right now. Number 1. NVIDIA. It might be difficult to think of a stock that has gained nearly 240% this year as undervalued, but shares of NVIDIA are now trading at their lowest forward earnings multiple in 8 months. The lower valuation is due to analysts across Wall Street raising their estimates for NVIDIA's future earnings, leading to a drop in the price-earnings multiple at which NVIDIA's stock is now trading. Analysts now expect NVIDIA's revenue for the fiscal year ending in January 2024 to reach $53 billion, nearly double the previous year. NVIDIA's stock is now trading at the equivalent of around 33 times expected earnings over the next 12 months, according to Refinitiv data. That's down from a P/E ratio of 46 just 1 week ago and is the lowest level since December 2022. Analysts' upward revisions to NVIDIA's future earnings come after the company raised its forward guidance, saying it expects revenues to rise 170% from a year earlier in the current third quarter, driven by demand for their artificial intelligence chips. Additionally, NVIDIA has announced that it plans to buy back $25 billion of its own shares, suggesting that the company views its stock as undervalued despite more than tripling year-to-date. Number 2. Chipotle Mexican Grill. Down 13% from a 52-week high reached in late July ahead of its second quarter financial results, Chipotle Mexican Grill looks like a buy at current levels. While the quick-service restaurant chain is not a high-flying technology company, its stock has been a long-term growth story, having increased 300% over the last 5 years and nearly 4,500% since going public in 2006. Buying Chipotle Mexican Grill stock on post-earnings weakness is likely a smart move for investors who play the long game. Chipotle's second quarter print wasn't that bad. It certainly doesn't justify Chipotle Mexican Grill stock being down more than 10%. The company reported second quarter earnings per share of $12.65, which was better than the $12.31 expected among analysts. Revenue in the quarter totaled $2.51 billion, which was only slightly below the consensus expectation of $2.53 billion. Also, Chipotle's operating margins grew to 27.5% in second quarter from 25.2% a year ago. The sell-off in Chipotle Mexican Grill stock has been due to the company's forward guidance, which came in lighter than Wall Street anticipated. The company noted that higher prices for tortillas, dairy, beef, and other ingredients are likely to pressure profits in the near term. Regardless, Chipotle and its stock are likely to remain a growth story over the long term. Number 3. PayPal. If there's one tech stock that looks heavily oversold right now, it is financial technology giant PayPal. The company's stock is currently trading only slightly above its 52-week low, having fallen 33% over the last 12 months, including a 16% pullback so far in 2023. Trading at 17 times future earnings, PayPal stock looks cheap compared to many other tech stocks that trade at multiples that are 2 or 3 times higher. Currently bouncing off its 52-week low, now might be an advantageous time to take a position in PayPal stock. PayPal stock slumped 8% after the company posted its second quarter results in early August. The decline came despite PayPal announcing earnings that were in line with analysts' consensus forecasts, with the online payments company reporting earnings per share of $1.16. Revenue came in higher than Wall Street expectations at $7.29 billion versus estimates of $7.27 billion. Yet, despite the decent numbers, PayPal's shares sank. On a positive note, the company recently got a new CEO in Alex Chriss, who previously ran the small business group at Intuit. Thanks for spending some time with us today, Timely Investment Research. We're so glad you did. If you found value in today's video, please give us a like, hit that bell icon to never miss an upload, and hey, don't forget to subscribe.